Hello, welcome back to this week's market update. We hope you all had a great July 4th weekend. Today is July 6th, 2026, and we'll jump right in. Markets started the second half of the year on a positive note, with investors reacting favorably to the cooler than expected June jobs report during the shortened holiday trading week. The Nasdaq Composite slightly led the major indexes, up 2.1% last week. The Dow Jones closely following, up almost 2% last week. And then the S&P 500 not far behind, up 1.76% last week. Moving into our economic data from the week, we did get the June jobs report where bad news was kind of good news in the weaker than expected data. So June's job growth came in at 57,000 for the month, less than half of the consensus estimate of 117,000. Now, markets reacted positively to the soft reading as slower job growth reduced concerns that the Fed may need to raise interest rates later on this year more aggressively. By sector, professional and business services added 36,000 jobs, social assistance gained 25,000, and healthcare added 22,000, while leisure and hospitality actually lost 61,000 jobs due to weaker than expected seasonal hiring. Most other industries saw little change during the month. We also had a declining unemployment rate that fell from 4.3 to 4.2% here, which is really unique considering that we had below average job growth. We'll take a look at one of the dynamics driving that unemployment rate lower in the next slide. One unique dynamic behind that falling unemployment rate is a falling labor force participation rate. This is the percentage of the population age 16 and up that is either employed or actively looking for work, and it fell to just 61.5% in June, its lowest level when you exclude the pandemic, since the 1970s. While the decline has recently been attributed to demographic trends, including retirements of the boomer generation as well as lower immigration in recent years, June's largest drop came from prime age workers, aged 25 to 54, a development likely to receive increased attention in the months ahead. All in all, the report presents a mixed picture of the labor market. Job growth slowed after 3 months of strong figures, while wage growth remained healthy at 3.5% from a year ago. At the same time, the decline in labor force participation suggests that the lower unemployment rate may overstate the labor market's underlying strength right now. Even so, though, the weaker payroll growth was viewed positively by markets last week as it reduced odds for rate hikes later on this year. Continuing on in our week, we also got the ISM Manufacturing Index last week, as well as the Services Index this morning. The ISM Manufacturing Index remained in expansion territory in June at 53.3%, down slightly from May, but still in positive territory. Within the report, new orders and production cooled ever so slightly in the month, but both remained in positive territory. Inflationary pressures also eased, with the prices paid index falling from 82.1 to just 73 this month. Employment also improved in the month, increasing from a more bearish 48.6 to a more neutral 49.7. Manufacturing activity appears to remain on solid footing, with continued expansion and easing price pressures providing a constructive backdrop for the industry in the near term. We'll take a look at the services industry in the next slide. Now, it is not always the case, but the ISM Services Index showed several similar trends to the Manufacturing Index. First off, we saw a very small decline in the monthly figure here from a bullish 54.5 to still a fairly bullish 54%, well above that 50 threshold. We also saw slight cooling in business activity and production, as well as new orders, similar to manufacturing, and an improvement in the employment index from a bearish reading to actually a more bullish reading at 51.2%. Last but not least, the prices paid index in the services sector improved from 71.3 to now a much cooler 67.7. The report continued to point to a healthy services sector with an improving employment index and moderating inflationary pressures in both sides of the economy, both manufacturing and services, supporting economic growth in the near term. Last but not least, consumer confidence moved higher in June, rising zero point 0.6 points to 91.2 from a downwardly revised 90.6 in May. The modest improvement reflecting easing concerns over inflation as gas prices moved lower throughout June. However, beneath the surface, the report was more nuanced. The Present Situations Index, which measures consumers' assessment of current business and labor market conditions, actually fell 3 points, continuing its recent downtrend. On the other hand, the Expectations Index, which is the forward looking piece, improved in the month 3 points, extending its gradual improvement, which has been the case for several months now. Consumers viewed current business conditions slightly more favorably than in May, though perceptions of the labor market weakened. The share of respondents saying jobs were hard to get rose to 22.5%, the highest level since January of 2021, while expectations for business conditions and personal income did improve. All in all, the report suggests that consumers remain cautious about labor market conditions, but are increasingly optimistic about the economic outlook for the coming months. So that concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.